The top business stories live from the Sky Newsroom. An interest rate decision in the next 30 minutes, with the Bank of England expected to leave rates on hold for now. Oil prices surge as Israel steps up its attacks on Iran's nuclear sites. Plus, why Guernsey is seeking to attract non-doms leaving the UK. Very good morning on this Thursday Business Live with me, Darren McCaffrey. The Bank of England is set to announce its latest interest rate decision in just under half an hour's time. Most analysts are predicting that the Monetary Policy Committee will keep rates at 4.25%. Yesterday's inflation figures came in slightly higher than predicted and remain above the bank's target of 2%. And now, with Israel and Iran potentially involved in all-out war, it's adding to the uncertainty with oil prices on the rise. Well, let's bring in our economics and data editor, Ed Conway. Ed, very good morning to you. So the assumption is we're not going to see a change at midday.
Yeah, on hold. I think that's what everyone expects. It would be a big shock if they did anything, and obviously they have signalled that they're going to keep on cutting interest rates. So obviously rates have come down from their highs of 5.25% down to 4.25% now. Looking at what most analysts and kind of what people in the markets expect, they think it's going to keep on going down, but relatively slowly now. So we might have now seen the kind of, the big fall in interest rates. The big question is what happens next. And, the things to look out for. So look out, obviously, the decision itself, that's more or less going to be as expected. So on hold. Like I say, you never say never, but it would be a total shock if they did cut interest rates. The second thing to look out for is what's the composition of the vote. So how many of the members of the Monetary Policy Committee are voting for a cut? How many are not? And I think economists think maybe it's going to be kind of 7-2. There's 9 members of the committee, but you're kind of getting a sense from that as to where people might be heading in the future. And then I think the third thing to look out for is alongside that decision, and I know, most people are looking at it for that number, and the number, as I say, is going to be unchanged, so it might look like there's nothing going on beneath the surface. But alongside that decision, we also get the set of minutes from the Bank of England, and those minutes contain often all sorts of interesting hints as to where they are heading in the future. It's not like a big kind of revision to their economic growth forecast. We tend to get that, you get that every quarter when they do their monetary policy report. So this isn't as vast as that, but you do get hints often about, look, it looks like we think that inflation is edging a bit higher than we expected. It looks like growth is a little bit lower than expected, all of those things. And there might well be some words along those lines. Again, very difficult to know until we see those numbers and until we see that report. But between all of that, we might have a better sense this afternoon, or at least, after 12 o'clock, once we've looked at some of those bits and pieces, we might have a better sense as to where they're going in future, because that's the real question now. Are they going to cut interest rates in August, which is the next obvious time that a lot of people thought they might do it, or are they going to wait until November? Or indeed, might they not cut at all, given, as you were saying just in your introduction, Darren, there's a lot of other things going on right now in the global economy.
And isn't that the point, Ed, as you say, you have to take into essentially factor in the inflation rate, you have to factor in growth rates, but also clearly a very uncertain, unstable world at the moment.
Yeah, and it's really quite hard to divine just at looking. First of all, people don't really know what Donald Trump is going to do on any given moment. I mean, that was one of the things that, as if you've been watching our coverage of the geopolitics, everyone's trying to second guess this, and no one has a clue. Secondly, you're trying to second guess what the economic permutations of that are going to be. And traditionally, when something like this is happening, that means oil prices go through the roof, gold goes through the roof, all of these different things. But do all of those things stack up in the way that they do historically? I mean, the US is now the world's biggest oil exporter, an oil producer, and that is something that wasn't the case, for instance, the last 2 Gulf Wars. So certain things have changed. But broadly speaking, you would expect if oil prices are going up, for that to feed obviously into petrol prices and into everything else in the economy. I mean, we've learnt that, haven't we, in recent years? Higher energy prices means higher, broader inflation. I think the question mark is, so many of these things are so difficult to model. So it's not just what's going on with the Middle East. It's also tariffs. Economists find that very difficult to model. And when the Bank of England last looked at tariffs and what that might mean for the UK economy. They kind of said, oh, well, it's probably not going to have that big an effect. We're not talking about a recession. It might dampen down growth a little bit. It might have an impact on inflation as well. But actually, they weren't talking about it kind of going through the roof. They were talking about it being dampened down because there's less activity, because tariffs kind of dampen that all down. But again, it's very hard to really map that and model it. And so you're in this place at the moment where you have these two vast economic stories, which probably should have an impact on inflation, but no one's quite sure what that impact is going to be. And that means, frankly, interest rates might be going in a totally different direction to where we expect them to in the coming years, which is all of what I think why everyone's kind of looking towards the detail and the nuance rather than that overall decision today.
OK. Ed, as always, great stuff. And Ed will bring us that decision from the Bank of England at midday here on Sky News. Let's bring in, though, Ellie Groves, who's from State Street Global Advisors. Ellie, very good morning to you. As I say, we're all working on the assumption that rates will be held today at midday. But as Ed was suggesting, it'll be fascinating to see who thinks what when we get the details of those minutes.
Thank you. And thank you so much for having me on. So I actually agree with a lot of what Ed has said, which is that fully expecting a hold today. But what that looks like into the future is incredibly uncertain. And the Bank of England is at a restrictive space at the moment. So there is room to potentially cut, but they have to take into account the wider elements of the geopolitical outlook.
And what's fascinating here, isn't it, is trying to work out, we've kind of seen this ladder with rates being gradually cut over time. Is that going to continue? At what pace? Or even, as Ed was suggesting, maybe it all stalls given the uncertainty?
So I think at the moment where inflation is, which is higher than their 2% goal. But if you actually are looking at some of the drill down into some of those numbers, so you're looking at April where inflation was ticked up slightly higher than they were expecting. Some of that is due, our analysis of looking at that, some of that is due to the road tax and also due to higher plane flight costs throughout the Easter break. So actually, if that doesn't continue, so if that kind of continues to actually see the baseline slow and steady, if you're looking at wage, we're entering into a time of wage weakening, so you're actually in a relatively good space there. You might see a cut in August, as it said, but again, that careful, gradual approach that looks at the data, that looks at the global wider impacts that we're in.
Okay.
August and November are still sort of base cases of a 25 basis point cut each time. Basically the same trajectory that they have been doing,
Okay.
So sort of one cut, one
and
off.
just briefly, Ed, if you can, what about when we look at the ECB, we look at the Fed, how is the Bank of England compared to the other central banks?
Again, if you actually look at how central banks are navigating this uncertain time, it's the slow, it's the steady, it's the taking cautious. The ECB took a 25 basis point cut, as we know, but that was because their inflation figures are at 2%. So they had that room. They're still in restrictive. There was that room for them to slow and steady cut. Fed hold. Everyone is just sort of waiting and seeing how the tariffs play out, see how the war plays out in the Middle East, and see what happens to those oil prices. Okay. So I think that everyone, while they might be making slightly different decisions, the central banks are looking at it in the same way, which is data-driven, which is slow, steady, gradual, cautious.
OK, Ellie, really appreciate your insights this morning. Ellie Groves there from State Street Global Advisors. Thank you. Well, as we were hearing, one of the factors worrying central bankers at the moment is the volatility in the oil market because of the heightened tensions in the Middle East. Well, tonight we can speak to Chris Beauchamp, who is Chief Market Analyst at IG. Chris, good morning to you. I suppose my first question is, there is a lot of uncertainty because we're still waiting to see how much the Americans may well get involved. But we have seen oil tick up reasonably significantly in the last couple of weeks.
Certainly. And of course, markets don't really like surprises. And Friday's events in the Middle East were definitely a surprise. We sort of knew an attack might develop, but not quite as soon as it did. And I think that's partly why you saw such a sharp reaction on Friday in the oil price. It's calmed down since then. But as you say, the big wild card here is American intervention, with the possibility that expands the conflict. And of course, the big worry is what happens to all those oil tankers transiting through those Iranian straits where they could come under attack by Iranian forces.
Yeah, that's the fascinating thing here is, I mean, I want to get your take on what Ed Conway, I don't know if you listened to what he had to say earlier about the fact that obviously this is different from the 1990s and the early noughties in that America is not as reliant, the global economy is not as reliant on Middle East oil, but as you say, those shipping lanes are very vulnerable to either Houthi or Iranian attacks.
They are, very much so. And I think you're right to say it's not the same picture as it was 20 years ago. OPEC is less important in a way, and so you do have more compensating factors. So we're not expecting a huge spike in the price of oil. And remember how much higher oil was in the wake of the Russian attack on Ukraine back in 2022. It's come down a lot since then, which in a way does make life a lot easier for central bankers. Yes, oil prices could go up from here, and that impacts inflation at a very tricky time, but not as much as it used to. And the likelihood is, of course, if you do have another big spike in the oil price, OPEC and other producers will come in to mitigate that effect. So we're not expecting a major oil crisis at this point. Certainly, it looks unlikely, but undoubtedly there could be further volatility, certainly in the short term, that puts more pressure on consumers and, of course, on the Bank of England. And
Chris, just very finally on that, if we do see those oil prices increase significantly, if things do deteriorate, what type of impact would we look at that having on the global economy, for example?
Well, given how important it is to most consumers, you can expect some material hit to consumer spending, and you could then see that feed through into lower earnings for companies. We are still very finely poised here for a recession, given the uncertain impact of tariffs and how much of an impact that's having. We don't really know at the moment. It could just be enough to tip the balance towards a much gloomier outlook for the global economy in particular.
And as you say, what's fascinating here is that, yes, the kind of sources of oil have changed, haven't they? To a reasonable degree over the last couple of decades, but our reliance on oil, whether it's still to fuel our planes or for plastic or for our cars and transportation, we're still pretty reliant on it, despite the changes in technology, even in the area of green energy, for example.
Massively. It's no longer just about energy. It's about, as you say, plastics and so many other products that you wouldn't think have oil in them. So we can't just say, well, it increases the need to move towards renewables. Oil remains a crucial part of the whole economy, and Middle Eastern oil, which supplies some of these crucial energy elements, is still going to be crucial. And of course, look at China, which is ignoring everyone else's push to renewable energy and continuing to consume oil on a vast scale, really far larger than what we're doing in the West. So it's not as if oil is going to go away as a major issue, even in the medium to long term.
OK, Chris, great stuff. Thank you very much indeed. Chris Beesham there from IG. Thank you. Now, the government's decision to make so-called non-DOMS assets liable for inheritance tax has reportedly seen many of the wealthiest people in the UK leave the country and seen the number of London homes for sale at 5 million quid or more rise to the highest on record last month. That's according to research from LonRes. So where are they taking their money? Well, Guernsey is hoping to attract the wealthy with its offshore banking. A new offshore bank, Bank Aston, has just launched there. And joining me now is Paul Gorman, who's Chief Executive of that bank. Very good morning to you. You're pretty unashamed about this in some ways. You want these wealthy people to come and bank in Guernsey.
Well, we'd expect them to want to, really. It's economically, and geographically adjacent. It's got the same rule of law. And maybe some other places are less attractive. A lot of people don't want to go back to the US at the moment. And there are some other jurisdictions offshore that haven't done so well in their financial crime assessments and have gone onto the grey list. So, Guernsey is a very strong island, very well regulated, adjacent to the UK, 45 minutes out of Gatwick. And, if the money is going to go somewhere, then why not? So we're not encouraging people to...
Well, that's the thing, isn't it, Paul? Is it, well, you say the money's going to go somewhere, but you are essentially encouraging people, aren't you? Because of all the factors that you've just talked about.
No, I mean, the economic data is already showing, capital gains tax is already down, which tends to be taxes paid by the wealthy, and the exodus is well documented. Front page of the papers are showing it, including senior bankers who don't want to live in the UK or Europe. are choosing to just be elsewhere and manage their businesses from elsewhere. The other thing is that, trickle-down economics is a straw man that really nobody's ever tried to argue. Nobody quite knows where it came from. But these people are wealth creators, and they help the economy overall. And, if they're leaving the UK, that's bad for the UK.
Okay.
We started the process of setting up Bank Aston in November 2023, which was well before any of these things started hitting the press. The Tories got ahead of the Labour Party and announced that they were going to do it. So it wasn't the politics suggests it would have happened anyway.
Okay.
And, Guernsey is well regulated, it's trust friendly, has a lot of funds and fund administrators and family offices. And we're already seeing Guernsey being a net beneficiary of this attack on the world.
Just on that point, Paul, I mean, you talked about the fact there has been a lot of press coverage of this, and there undoubtedly has, of people, it seems, leaving the UK. Just in terms of, I don't know if you can give us specific numbers here, but what have you seen? I mean, have you genuinely seen an uptick in people going to Guernsey and elsewhere? Not just anecdotally, but actually in terms of like hardcore kind of numbers, if you like.
Yeah, I mean, I've seen it from people who we speak to in the UK who are leaving. And then I've also seen, I'm in Guernsey right now, and we hear of an influx towards Guernsey and also into Jersey as well. I don't know the numbers because a lot of the numbers are obviously going to be quite private. But the exodus is undeniable, and I don't think it's contentious to say that it's happening.
And we're talking about, and we've seen an impact that this may be having on the housing market in London. We've seen in boroughs like Kensington and Chelsea and elsewhere that houses there just are not selling as much as one would have expected, given what we've seen in the past. So, I think it is fair to say there are real-world consequences, but it's also fair to say there are lots of reports that Rachel Reeves may be looking at backtracking a little.
Yes, there's a chance of some backtracking in certain areas, trying not to make it not look like a U-turn. But I think once you start down the track of saying, not just non-doms, but taxing the wealthy, I think you've opened Pandora's box in that area, and people are going to start making plans.
Okay.
I think, plans were underway already, but nobody had actually done anything about it until the changes were made. I think there was a bit of hope that it wouldn't actually happen, but now that it has, that the exodus is clear.
Well, and just finally on that though, Paul, people watching this programme who will understand that wealthy people have got the ability to move around, but will also think, this is essentially just getting some of the wealthiest in our society to pay a bit more to help support things like the National Health Service and other public services that, frankly, have had a pretty tough time recently. What do you say to people who just say, Britain is just trying to extract a bit more money from some of the wealthiest in societies to make our society a bit more equal?
It's an understandable sort of sentiment, but the top 1% already pay 30% of tax, top 10% already pay 70% of tax, and you can't tax it. I think Keir Starmer said himself, you can't tax yourself into prosperity. I think what you need to do is grow, and hopefully grow faster than your national debt is going up. And if you're going to grow, then you need to have people in the country who are going to be able to lead that growth.
Okay, Paul.
And if you're pushing them away, then they're going to go somewhere else. And if they're going to go somewhere else, then why not to Guernsey or into Jersey?
Okay, yeah, you got that in at the end there. Paul, appreciate your time. Paul Gorman there from Bank Aston. Thank you. Okay, you're watching Business Live here on Sky News. Coming up in just a couple of minutes, we're going to be looking at how the markets are doing this morning. FTSE down just a fraction. All the details after the break.
We're rolling.
Welcome to the world.
Our new podcast, starting now. It's very exciting. Every week, we'll be reporting from the world's trouble spots.
We get to hold those in positions of power accountable, and we get to ask the questions that the audience, the listeners, want to know about.
And that's why it is so important that people tune in, come along for the road, come along for the journey. It'll be fun.
Very welcome back. We're just going to bring you up to date with a little bit of breaking news coming into us here at Sky, and that is coming from Moscow, from Russia, who have been urging effectively Israel and Iran and the United States to get involved in talks, given the increasing attacks that we've seen in the last couple of days. Well, they're urging Israel to immediately halt air attacks on the Bushehr nuclear plant. They say that is because Russian experts are working there, and they're also warning the United States, Donald Trump, not to get militarily involved in the Israel-Iran situation. So Russia essentially saying and calling for de-escalation, telling Israel to stop their air attacks, and also warning the United States not to get involved. Okay, let's bring you up to date with how the markets are doing this morning. Let's speak to Lindsay James, investment strategist at Quilter Investments. Very good morning to you. And can we start with Google? They've been dealt a bit of a blow by the EU and their top court.
Yes, that's right. We've had the European Court of Justice ruling today in support of earlier findings by Brussels that Google used its Android phone operating system really to pressure rivals, and they upheld the recommendation of a fine of just over 4 billion euros. So this could end up being the final chapter in what's been almost a 10-year investigation now by the European Commission, alleging that Google abused its dominant position in search, effectively requiring those device manufacturers to pre-install Google Search and Chrome, and preventing phone companies from using alternatives. And also it's coming at a time when there's already been a fine of just over 2 billion euros for favouring the comparison shopping service as well ahead of rivals. But of course, very sensitive time for US-EU relations at the moment. Donald Trump's targeting the EU digital services tax with his own clause in the spending bill. And we've got also, of course, tariffs decisions upcoming, and he will not like to see this fine upheld.
Thames Water also back in the news today. I just see The Guardian in the last couple of minutes saying apparently the Environment Secretary is stepping up preparations for temporary nationalisation. They're a company that seem to be in perpetual turmoil.
Yes, of course, the latest chapter of this long-running saga. But I think some of the proposals that we've seen coming out of the group of creditors who are trying to take control of the business, they're really going to be quite outrageous, I think, for viewers. You know, they're really asking for exemptions for environmental laws, existing fines to be scrapped, and the power to raise prices at any time before 2030. And the existing fines are very significant: 104 million for failing to manage sewage works properly, 18 million for excessive dividends. And the creditors also acknowledge that there's what it terms a clear, deep-rooted environmental non-compliance gap. In other words, they're a long way from being able to follow the law on this. So as it stands, 350 pollution incidents in each of the last 2 years, more fines likely unless the infrastructure is improved. So, you know, I think a lot of news on this story. I think we'll keep hearing more and more.
Lindsay, great stuff as always. Thank you very much indeed. Lindsay James there. OK, that's it from me for the moment. Business Live back, of course, at 4:30 this afternoon. Coming up next, it is that interest rate decision with Ed Conway at midday. Stay tuned for that, and I'll see you a little later. Goodbye.